Good afternoon, everybody. My name is Matthew Court. I'm the Vice President for Sales and Marketing, and this is Dave Gilbert, our Chief Operations Officer. We represent VisibleEquity. VisibleEquity is an analytics company that does data analytics for bank, credit union, and finance company clients all across the United States. And today we want to introduce you to a new service or an expansion of our services, Fair Lending Analytics. Now, why is Fair Lending Analytics important today? Well, discriminatory lending laws have been on the books in the United States for 40-plus years. But with the recent economic downturn, with the expanded need for credit availability, with the data that come along with those new loans, and the expanded abilities for data warehousing and analytics, the environment is right for the examiners to expect a thorough understanding in each financial institution that no discriminatory impact is happening on any of the protected classes. Now, this, of course, is tricky. Fair lending is very complex. In fact, it begins prior to even obtaining that new loan in the way in which you approach a new borrower, all the way through the life of that loan to the end when that loan matures in one way or another. So we're going to speak specifically today in our short time about two aspects of fair lending that cause particular challenges for financial institutions. Number one, identifying the prohibitive basis group or the protected class of the borrower. And then number two, analyzing those pools for whether or not there's any pricing discrimination occurring. Now, why is this a big deal? Well, with HMDA laws, Home Mortgage Disclosure Act laws, financial institutions have been able to aggregate data across race, age, gender for quite a long time. But the fair lending examinations are incorporating all aspects of lending, consumer lending, and not just residential. And so that information isn't readily available, and this becomes the challenge. How do you break down the protected class of the borrower to determine this when you don't readily have the data? So what VisibleEquity has done is we've utilized statistical modeling techniques to be able to identify those protected classes and then analyze them for pricing discrimination. So specifically today, let's talk about race. When looking at, there are folks back in my corporate office, obviously, that they want me to talk about multivariate linear regressions and Bayesian statistics, and I knew this presentation was going to be after lunch, so we're going to not do any of that. But we're specifically able to take information that you do have from your loan applications and loans and then produce reporting that will break this down into ethnicities. Specifically, address, zip code, first and last name, other factors are able to help us determine the ethnicities of the borrowers. Once we do that, then we're able to look at that from the perspective of is there pricing discrimination occurring across any of the protected classes. So in this particular case, looking at the screen, you see the column that says average interest rate. That average interest rate may lead you to believe that there is disparate impact occurring. For example, the top column has a 9.11% average interest rate, whereas the third column has a 5.9 something percent interest rate. And that may lead you to think that there's some sort of problem, but this is actually an issue with fair lending exam. You want to not analyze it in that particular way. You want to analyze it after controlling for your underwriting criteria. So as you look at the next column, average expected interest rate, that's the way in which you're analyzing for pools of borrowers that have like underwriting criteria. So in this particular case, we've made it really easy. Now, we can show you T-stats and we can show you other things behind the scenes, but we've made it really easy. If you look to the far left, green means low likelihood of disparate impact. Gray means that there isn't enough data available to definitively say. And red, of course, everyone knows what red means. Red means there's a high likelihood of disparate impact occurring. And as you can see, with the average interest rate being 9.11%, but the average expected interest rate being 8.52, at over a half a point difference, there's some sort of issue there. Now, we could get into much more of the detail, but I want to just tell you that we know you live in the real world, so you need to be able to report on it. You're going to talk about this in senior management meetings, board meetings. You're going to need to talk about it with examiners. So it's pretty, very easy to understand. You have table-based representations of the data. You have charts and graphs. fact, as Dave clicks on it here, you can see some graphical representation of these reports. You also have the ability to interact with them. So for example, if he were to drill down on a Hispanic borrower group, when he gets down to any particular level, you'll now have more granular loan listings of data. Very easy to create watch lists or other different types of activities if you need to work loan by loan. In fact, you can even drill down into individual loans where you're going to then see aggregated information on the characteristics, the grading methodologies, more borrower information, collateral information. In fact, if you scroll down to the borrower there, you can even see the exact percentage that this particular borrower happens to be African American, over 94% in this particular case. And so what we're able to do with our fair lending analytics is give you the ability to determine the protected class of the borrower, race, age, gender. Drill down into those to make sure that no pricing discrepancy is occurring. And you can be assured that your underwriting criteria or individuals within your organization, I mean, let's face it, as you get into networks of indirect auto dealers or expanded branches or loan officers, things may be happening from a lack of education perspective all the way through actual malintent. You need to be responsible. We all need to be responsible for all of that. In fact, I would say at this point, fair lending analysis is important because the examiners are going to come and ask about this. There's no two ways about it. If your financial institution has not yet, it will have a fair lending exam. But the reality at this point is the environment's right and the ability we have is right to make sure that all borrowers are treated equitably, that their ability to manage their finances is what determines their ability to get borrowed money, not any other factor, especially not race, age, or gender. So at this point, we thank you very much for your time today. We appreciate the opportunity to talk to you about fair lending analytics. We find this very important. We hope you have a great afternoon. Thanks.